Hello and welcome to Securities Lending Saturday. I'm Roy Zimmerhansl and I'm your host. Today, we're going to be talking about short selling, one of my favorite topics. I'm not going to be talking about how you set up a retail account, but more how it impacts the business because every short sale that's covered involves a securities loan, but not all securities loans involve short selling. But it is an integral part of the business. So if you're involved with securities lending as a lender, a borrower, an intermediary, part of the ecosystem that drives it, or you're just interested in learning more, then this is the place for you. So let's get started. Hi, everyone. It's Roy Zimmerhansl. Another Saturday. I'm super excited today. I've got a lot of energy. This is a great topic. It's really important that people understand it. As always, I've got a slide deck, which I will magically show up there now. This is what we have been talking about. This is week 28. We skipped a week because of technical problems. Today, as I said, we're talking about short selling. And next week, we're going to be looking at transparency. Nick, really good to see you. Thanks very much for joining me today. Appreciate you spending some of your Saturday with me. The things we're going to be covering are fundamentals. What is it? Is it legal? Is it good? Is it bad? Is it risky? Let's talk a little bit about naked short selling, and that's not a day trader sitting in front of their computer with no clothes on. I'm going to talk about short selling bans, and maybe people will be surprised at just how commonplace they have been over the years. We're going to talk about the costs of short selling because it's not the same as investing. And then we'll look at some different alternatives to achieve similar economic outcomes. Please give us a thumbs up if you think that this or other videos are useful. That's good. It gives me a view on what you like, what you don't like, what works for you, what helps you understand the business more, because that's what my mission is, right? These are all about just understanding the business, right? So that's what we're trying to do here. Securities lending is something that is definitely a growing business activity. There's no question that it's spreading around the world. When I show you the list of markets where securities lending and short selling happens, I think you'll be surprised at the number of markets. If you were away 5 years ago or 10 years ago and you've come back, there are a mass of new markets out there. I think it's something that's definitely bound to keep growing. Investors, regulators, politicians even recognize the value. So let's first talk about what is short selling, or what the heck is it? And what we're talking about here is short selling is an investment technique that speculates on the decline in the value of an asset. And that asset could be stocks, it could be bonds, it could be currencies, it could be commodities. A lot of people are surprised that there has been such a long running commodity lending market. So things like gold have been borrowed and loaned out for hundreds of years. So this is nothing new. The same with stocks. So that surprises a lot of people, but that's basically my definition of it. And if you really want to know how to set up an account, what's actually required, what the regulations are from a retail point of view, granted, this is very much from a US perspective, but here's a couple of great videos that give you the real basics on short selling that are available on YouTube. And I recommend you check these out. So have a look at those. I have to admit, I'm having a little bit of trouble with my screens today, getting everything sorted out. So there you go. That's me popping up. In fact, is it legal? That's the most important question. In the old days, like in the 90s, what we used to do is see whether it was illegal. And if it wasn't illegal in a market, then we must have assumed that it was legal. Otherwise, they'd say it's illegal. That's not what it's like this century. But the question was, is it legal? And the answer to that is it depends on where you are. And I'll show you some markets where it is legal and where it is practiced today. There's also other regulations which cover short selling in terms of what the requirements are for specific markets. I have a little bit more on that in this video. I'll put a link in the final edited version. Yes, thank you, Martin. I'm aware that I need a producer. Are you volunteering? because I would love to have a producer. Anyone that wants to get experience doing producing for free to help me do this, you send them in my direction, because I would love that help. But yes, I recognize I need it. So anyway, there's a lot more on the demand side regulations which cover short selling, particularly the reg show and the European Union regulations about short selling. There's specific requirements that you need to fulfill before you can do a short sale in the first place. And then after having done short selling, there's compliance and disclosure obligations which you need to meet. So have a look at that video. That'll give you some more information on it. So if we now go to the countries. So here you go. Here are the countries. Look, this is never an exhaustive list because who knows, new countries pop up all the time. You can look at markets like Philippines, right? So the Philippines is in the midst of enacting short selling regulation themselves, but you could say, is it available for onshore domestic on exchange activity, or is it available for offshore? And that's always the question mark that you actually have in looking at any of these markets. If you go back to previous videos that I've done, I've also made the point that the most robust markets are the ones where there is domestic shorting and lending activity, foreign shorting and lending activity, and the ability to trade cross-border. That is a robust market. So look, this is pretty widespread. If you look on YouTube and do securities lending and short selling, Kenya pop up surprisingly with a huge number of videos. Look, this really is becoming a worldwide activity, and that's important for portfolio managers. If you are an investor, there's lots of opportunities to get extra juice from the assets that you're already holding. Okay, now the big question, is it good or is it bad? So let's look at the bad side of things first. People don't like the fact that short selling generates profits based on a company doing poorly. Nobody wants to revel in the fact that a company is experiencing trouble or maybe even going out of business. But look, it's a fact of economic life. There are winners and there are losers for whatever reason. And so why should profitability just be restricted to the upside? Now, look, it can cause short-term distortions, right? There's no question that there are times and specific instances where short selling drives the price of a stock. But again, that should be only reflective of poor performance of the stock, or if it's short term, maybe the company has answers. Maybe the company does give responses, and maybe the company does take action if the accusations or the underperformance can be targeted, identified, and remedied. But there's no question that there are points in time. There are specific stocks. Of course, mid cap, small cap stocks may be more impacted than the large caps. So there can be problems resulting from short selling. The question for regulators, is it abusive? All right, that's the real challenge. And of course, there are always going to be challenges about abuse or price manipulation on the short side, just as there are accusations about pump and dump schemes on the long side. Now, it can expose fraud or bad practice, and you might think that's a good thing. But I got to tell you, a lot of investors in the company don't want to have their companies be outed as having bad practice because it reduces the impact and the price of their stock. And nobody wants to see their stocks go down. So I have come across people who say that they would rather turn a blind eye than to have it be exposed. It's also one of the problems with it is it's not available for anyone. Traditionally, this has been an institutionally driven market. This has been available to professional traders and hedge funds, and not everyone. And so it's exclusive from that point of view. It's risky, which we'll talk about a little bit later. And I've already talked about abuse and manipulation. Just a couple of comments from the audience. Kartik, happy to see you with us. Megan, thanks again for pointing out the sound. Nick, yeah, appreciate you saying that you can hear me again. Otherwise, listen, I've done these. I've had to do them twice over before. Martin, listen, step up and be the producer, and I would genuinely appreciate that. And Martin also makes a comment that in newer markets, asking the question, is it common for exchanges to facilitate lending in order to support short selling, increasing liquidity in the cash market? Listen, I'm going to flash that one up because I think that is a super question. One of the things that we've seen many markets, really going back as far as Singapore, where what they said is, look, whatever happens with the professional investors in foreign markets, the truth is we need to focus on our domestic market to make it better and more liquid and have fewer operational problems. So we, the exchange, or we, the depository, will implement an infrastructure that either requires everyone to put all of their securities loans through us domestically so we can track and monitor it, or notwithstanding that, maybe just having a facility there for people trading on the market to actually be able to borrow and to improve liquidity and facilitate lending activity to allow better liquidity trading, fewer fails, and all of the other benefits that short selling brings, which I'll talk about momentarily. So that is a super question. You're 100%. I know the answer to that, so I appreciate you asking me the question so I could share it with everyone else. So look, those are the bad points. Now let's turn to the good points. It adds perspective to market prices. And what I mean by that is that if you only have a market where people can only buy stocks or bonds or sell stocks or bonds that they've already bought or not participate in the market at all, you get a very skewed market. It's only skewed to the upside. And as I said, nobody wants to expose fraud or bad practice. So what you have is stocks just continuously rising or having a tendency or skew to rise. And that may not reflect the reality of those stocks. Okay. That may not be the truth about what's happening with those companies. So by having short sellers involved, you get a different perspective. You get opposing views. You get people challenging companies on what they say and what they do and what their numbers tell the story of. Of course, more traders in a market always is going to add more volume and turnover, and that in itself improves liquidity. Just as exposing fraud or bad practice is on the bad side, I argue that, in fact, it's on the good side. That's where it should be firmly placed because we want companies to have good practices. We want companies that make ESG statements to be following through with those statements, not just the greenwashing, right? You've heard greenwashing. You can't just let companies get away and say, we're doing great things without having someone to police them. And frankly, regulators have too much on their hands to be able to police activities and every statement from every market participant. So it's just unrealistic. So it's left to investigative journalists and short sellers to expose fraud and bad practice. Ultimately, though, short selling really is a risk management technique. It's mostly used as a way to hedge against market exposures. And if you eliminate the ability to offset some of your potential losses in market corrections or stock specific events, then you are making it a less efficient market, which is why, in many cases, securities lending is considered an efficient portfolio management technique. In fact, in some markets, it's actually enshrined in regulation under that. And then, perhaps most interestingly, short selling securities lending is becoming available really to the masses, where it was thousands or tens of thousands of professional institutional investors and traders. It's now being made available to millions through brokers. Robinhood is the famous one, but also Webull and eToro and E-Trade, and Charles Schwab's been doing it for a long time. And we see brokers in South Africa. We see it in some of the European countries. We see it increasingly of interest in the UK, and of course in China, where Webull is, but also in Hong Kong, Japan. It's in many countries. And so that's the real driver for these stories, is I'm trying to get the word out about securities lending to everyone, because if you're not involved with it today, you will be involved with it tomorrow. Okay. And so to me, that's big. I also did I'll put a link in the recorded video to a video animation that I did in September of last year, where I predicted that one of the three big impacts for the future of securities lending was retail market participation, specifically through Robinhood, as a matter of fact. So I was lucky to have guessed that. Better to be lucky than smart. Okay, so that's whether it's good or bad. To me, ultimately, the question is it legal, right? And if people have a question about whether it's good or bad, that maybe is meant for a different forum. But is it risky? So if you look at conventional investing, where the mantra is buy low and sell high, buy something for $10 and sell it for $100. That's what you want to do. And so in conventional investing, the most you can lose if you buy something for $10 is $10. How much can you make? Look at the price of Tesla. It's $100, $200, $500, $1,000, $2,000. Look at the price of Warren Buffett's entity, Berkshire Hathaway. Look, I thought about buying a share back when it was $2,000. It's multiples of that and then again some. So look, you can make a lot more in terms of the risk profile. You've got more upside than you have downside. Now let's look at short selling. In that same example where I'm doing the opposite, now I'm selling it high and hoping to buy it back later low. So if I sell it at $10, the most I can make is $10 if it goes to zero, right? So I'm selling it at what I think is a high point and hoping it drops from there. So whatever my sale price is, that's the maximum profit I can have in the transaction. But of course, like Tesla, what if it goes to $1,000? What if it goes to $1,200? What if it goes to $1,500? So there's an unlimited loss, even where you're eventually proven, even with something like Enron, which went into default around the turn of the century, short sellers were calling it out at the price of $20 a share, shorting it then. It went to over $80 before the tables turned, the information came out, and it eventually went to zero very quickly. But still, you had to endure potentially a 400% loss before you got your profit figures. And most people can't afford that. So question, is it risky? The issue that you have to face is that over time, markets tend to rise. That's been true since we've had stock markets. They tend to rise as overall markets, maybe not individual companies, but as markets they do. And so the answer has to be yes, short selling is risky. So while I'm saying that it's more accessible to a wider audience today, that doesn't mean it's forever. It takes a special kind of attitude and personality and demeanor to be able to put up with the losses, the risk. Sometimes the public despise short sellers, and you have to be able to put up with that. Martin, I just saw your comment. Thank you very much. Martin said that I'm the securities lending oracle. Of course, oracles are most famous back in ancient Greece. Some days I feel like it's ancient Greece. As the weather's got colder and darker, the old joints have made me feel like I am from ancient Greece. But thank you very much, Martin. Quick thing about naked short selling. That's where you are short selling, but without making arrangements to borrow securities. So you're just actually putting in a sell order in the market and you don't care whether you can borrow the shares. That's not going to be of interest to you. It's a bother and a hassle. Of course, that's not really permitted in most markets because it adds systemic risk, right? If I sell you something, then you expect me to deliver it to you because you bought it for a reason. You want it. If I've never borrowed it, I can never deliver it to you. And because there's no constraint on how many shares I can put into a sell order, if I'm not worried about borrowing them, I can easily distort and manipulate market prices. So that's why regulators in most markets don't like naked short selling. There are exceptions. There are exemptions often for market makers who are given a little bit more time or sometimes still exempted completely in order to actually facilitate trades. But they know that they need to close them out in order to make their fees and their profits. It's also sometimes permitted with respect to some government bond markets, again, in order to keep the liquidity flowing there. But remember, naked short selling has nothing to do with properly conducted short selling. And it also has absolutely nothing to do with securities lending because, of course, there is no loan. So, securities lenders, naked short sellers. I don't know if they do. I do. That's the way it is. I call it as I see it. Let's look at short selling bans. Everyone, hopefully, watching this is aware that short selling bans happened in March of last year as a result of the market crashes resulting from COVID and Russia getting into a spat with Saudi Arabia on oil prices. But look at history, littered with market short selling bans. And this doesn't cover individual stock short selling bans, which happen, very regularly and it really in almost any market. But look, it goes from March 2020 all the way back to 1609. East India Company was one of the culprits that triggered it. The short selling ban in France, Napoleon called short sellers treasonous because it actually impacted the price that governments had to pay when they were issuing bonds, and they were issuing lots of bonds to pay for the wars that they had. In the War of 1812, short selling was banned in the US. A lot of people don't know that. I didn't know that until not too long ago. In 1997, the short selling, which had only just been opened up a couple of years earlier in Malaysia because of the Asian currency crisis, Malaysia changed their mind and shut it down again. And it was closed from short selling for many years. Again, famously, Malaysia was known for the fact that when short selling was banned before it was opened up in the mid 90s, it was actually subject to caning or public flogging as the penalty for being convicted of being a short seller. 2008, that was the peak of short selling bans, where at some point over 2008, 2009, there were short selling bans in over 30 different countries. During the sovereign bond crisis in Europe in 2011, and for different reasons in South Korea, there were short selling bans in 2011 and then last year. Now, the interesting thing is March 2008, we had a market meltdown. 30 countries put in short selling bans. You look at March 2020, it was only really a handful of countries. So, a very different kind of scenario. Maybe regulators are evolving, or maybe as I think Boaz Yari from ShareGain said in an interview, he said, well, look, maybe there's only 8 countries that put short selling bans in because the conditions only mean that they have impact in those 8 countries and they're less meaningful. So really what he's saying is that next time there might only be 2 countries that do short selling bans, or maybe next time it'll be 40. Interesting perspective. Personally, I think regulators are becoming more comfortable with it. They understand it more. And for those kinds of just pure market crash conditions, I think the number of short selling bans or the duration of those short selling bans is likely to decline over time. But time will tell. Some of the costs involved with short selling that don't apply, of course, in order to do short selling through your broker, you typically have to have cash or collateral or margin in order to even in order for them to allow you to do short selling through them. So the question is, what else could you be doing with that embedded capital? So there's an opportunity cost. There's also obviously a cost to borrow shares because the lender is only lending to make money. So there is a cost to borrow. And whereas a long investor, you receive a dividend or you receive an interest payment or you get the benefit of a corporate action, as the borrower, you have to manufacture that or pay it to the lender so that they're in the same place they would be had they not been doing lending. And then once you've got short selling in your mind, you have procedures that you have to comply with. So whether it's a locate and then recording the locate and keeping that record for many years, or figuring out what the the regulatory reporting and disclosure is, or the public reporting and disclosure is, where you have to do filing. There are a bevy of additional administrative costs that go into it. So if you think markets are going up over time, long investors don't really like short sellers. So you've got a natural bias against that. And then you have all of these costs on top of it, and it's inherently more risky than long investing. You can see why this is practiced by the few and not the. Just a quick hello to Fanny. Appreciate you being here as you are every week. So thanks very much. There are alternatives. You don't have to do short selling with physical stocks. You can do total return swaps, where effectively you're entering into a contract and it's your counterparty that writes the contract that's responsible for hedging themselves or not. So often you'll see a hedge fund that might do a total return swap. That stock loan, that short sale might still happen in the cash market from the swap writer, or they may be able to offset internally, or they may be able to offset against a competitor. There are many different options, but total return swaps are probably, next to the cash markets, probably the most commonly used alternative. Contracts for differences, not available in every country. Effectively, it's the same effect. It's just a contract. And as it says, the difference that it refers to is the profit or loss on having a position. So again, whoever is taking out that position may choose to hedge themselves. But it's just a tool. This is often used by retail investors, sophisticated or beginner level. You could buy an inverse ETF, and an inverse ETF is an ETF that tracks an index, except it does the opposite of the index. So if the index goes up 5%, the inverse index would go down by 5%. Or if the market falls by 10% and the ETF falls by 10%, then the inverse should rise by 10%. And so there's many of these inverse ETFs, and you're not shorting them, you're just owning them, but they are very volatile instruments because they reset every day effectively. You can do put options. So you have the option to actually put shares onto whoever the writer is. So you can get short. If the share price goes down, you can put it on to the writer at a higher price than the current market price. So that's another way to get exposure. Or you can sell a naked call. So again, this time you're writing the option, and if the price, then you have potential to profit, or you actually just capture the premium for. But that's probably, of all of these, that's probably one of the riskiest strategies there. And then you have futures as an alternative as well, and that might be index futures, or many markets have single stock futures on their most liquid stocks. So those are the alternatives that you can have, and you can put these together and combine them and write all kinds of different derivative OTC contracts to have combinations. Okay, so finally, I'm going to tell you that new course, the Introduction to Financial Markets and the Role of Securities Lending, that will be online next week. Finally, I've almost finished it. I will finish it this week, but it will be done shortly. We have the free primer as always, and the big mama of courses, the Introduction to Securities Lending course. You can find them all at our website, pierpoint.info/courses. Okay, so let's just summarize everything. Short selling, what is it? It's speculation on an asset value drop. Where it's legal, it's an important part of the market, often between 5, 10, 15% of the market turnover in some major markets is short selling activity. It's important because it allows investors in those markets to express opposite opinions and points of view and act as a risk mitigant for them to manage their portfolios. Is it risky? There's no question it's riskier than traditional investing. So don't act unless you speak to a professional first. Naked short selling is detrimental and typically not allowed. So give that a miss. Short selling bans, look, they have a long history, but no matter, even in the most markets where the short selling bans happen the most, it's never permanent, right? Even Malaysia took them forever to make it available, and then not too long to ban it. Well, they've made it available again. So look, I think short selling bans may have their time and their place. I think particularly I have a lot more sympathy for smaller markets like Greece, who have put in short selling bans from time to time, than I would for a major market like France, which is a common actor in short selling bans. There are many additional costs involved with short selling because it's a non-standard activity. There's extra pieces that involved, and you're having to compensate the original investor as well. So not only are you worrying about your position, you have to worry about their position as well. And of course, there are alternatives, but again, in many cases, those alternatives end up being reflected back into the cash markets themselves. So that's it for this week. Next week, we're going to be talking about transparency. This is a particularly timely topic. The SEC in the US has produced some proposals for making securities lending activity more transparent. I'm going to give you my comments on that. You may see some of my comments before then, who knows? But in any case, I'll give you a more considered view next week. That's what we're going to talk about. That's it for me today. Thank you so much for everyone. I really appreciate the number of people today, the number of comments. I appreciate you sticking with me through the sound problem, which, who knows? They magically changed the microphone, but I'm waiting for Martin, my next producer. That'll be the big announcement next week. Thanks very much. Have a great Saturday. Have a great weekend. Have a great week. And I hope to see you here next weekend for Securities Lending Saturday. Thanks and take care.